In this video, let's run through some of the assumptions of the efficient market theory or efficient market hypothesis. Some of these assumptions will include that there are many rational or profit maximizing investors So analyzing and valuing securities, analyzing and valuing securities. In addition, it talks about new information comes into the marketplace in a random fashion. And last but not least, it talks about investors adjust security prices. Now let's just talk about these a little bit more in depth. So when one of these assumptions tends to fall is where we find exceptions to efficient market theory. We're going to talk about the different forms, weak form, semi-strong form, and strong form in another video. But just focus on the assumptions here. When one of these assumptions tends to fail, the markets tend to act inefficiently. So let's look at first, many. So in certain asset classes, there aren't many investors. When we don't have many investors, obviously in a stock like Cisco or Tesla or IBM or something that's widely held, widely traded, we do have the criteria for many investors. We also have many analysts from Wall Street banks that are analyzing it. But for smaller cap stocks, or new companies, or stocks that have been around for a long, long time but have a very small investor base, we might be lacking the conditions for many investors. Other asset classes like venture capital or angel investing or timber or private equity offerings, we may lose the assumption of having many investors. That's where we tend to see inefficiency in the marketplace. Another one here, rational and profit maximizing investors. We assume that, and economists do in general, that people act rationally all the time. That isn't always the case, and people aren't always profit maximizing all the time. So when we have a market panic, then we might have people individually acting rationally. They want to get out of the market because they want to preserve their capital. But everybody can't be selling at the exact same time. We need to have buyers and sellers. We can't just have all sellers. That's when we have a market panic. So what might be even rational for one individual, cumulatively might not be rational for all individuals. That's when we get a panic. And the same thing can happen when we have what we call irrational exuberance. So when people are just jumping on the bandwagon when stocks are going up. So we can have the opposite. So we'll call it exuberance is the opposite extreme. So sometimes people do lose their rationality. So another assumption is we have the many rational investors analyzing and valuing. So here we have some questions. Do all investors have the same background in education? Right? If we assume that people have different education, different experiences, so we might have people that are able to analyze and some people that might not be able to analyze. So we can have a failure for very complex securities. We have a very complex asset class, a very complex structure. Investment banks are notorious for creating complex securities that the average investor, we then might fall into the category of, because of the complexity and the investor's education, then we do not have the qualification of many anymore, and we have an inefficient market. So another point here is new information enters the market in a random fashion. Well, this assumes a couple of things. So it assumes that info is cost-free. That certainly isn't the case. We all know that there's information cost to gain information. Some information is more difficult to obtain than others. So information for all investors isn't cost-free. Some people might have access to better information than others. So that can create for a breakdown in market efficiency. So it assumes that information is available to all. This isn't necessarily the case. Once again, there's a cost for gaining information. Some people have access to other information sources that other people don't. So we know this can break down. So, and then we also have another assumption that all people get the information at the same time. Again, this is not true. Some information is available at a quicker pace to certain individuals than others. Some people have the ability to absorb more information than others. So there can be a time delay before information is reflected in security prices. So, and lastly, investors adjust security prices. By doing their analyzing and valuing of information that comes into the marketplace, they're going to adjust the security prices. Well, this makes an assumption that there's liquidity. So if we have a breakdown in liquidity and there are no buyers or sellers, then we can't create transactions. No transactions. So, and if we have no transactions, the information from analyzing and valuing can't be incorporated into security prices. So just a couple of things to note in terms of some of these assumptions for efficient market theory and how they can break down. Hope this video was helpful.